70% of lottery winners end up bankrupt within a few years.
Yeah.
Which, I mean, it sounds completely absurd until you realize that mastering money has, like, very little to do with math.
Oh, absolutely. It's almost entirely behavioral psychology.
Right. And that is exactly why today we are taking a deep dive into the art of money management, especially for beginners. We're looking at a bunch of sources on financial frameworks to kind of decode how you can build a system that bypasses your own psychological flaws.
Yeah, and the overarching theme in all these sources is shifting from a defensive posture to an offensive one.
So, like, taking control.
Exactly. It's about structuring things so you dictate where your money goes rather than, getting to the end of the month and wondering where it all disappeared to.
Well, let's start with the map every beginner needs, the 50-30-20 budget. So think of your income like a nutritional plan. 50% goes to essential nutrients like rent and food.
Yeah.
30% is for dessert, so your wants and fun. And then 20% is for long-term health, so savings and debt.
That's a great analogy.
But, okay, let's be real for a second. If you live in an expensive city, like New York or London, rent alone could easily eat up that entire 50%. So isn't a strict 50% for needs just totally unrealistic?
Well, yeah, but you have to remember, these percentages are meant to be a baseline diagnostic. They aren't like a rigid, punitive law.
Oh, okay, so they flex.
Right. If your rent and groceries demand 70% of your income, the framework immediately highlights that you have a structural problem. It basically forces you to compress that wants category maybe down to 10% just to protect that crucial 20% for your future.
Got it. So just a quick summary for beginners here. Budgeting isn't some sort of financial prison. It's literally just organizing your money into clear, flexible buckets, right?
Yeah, exactly. The real objective is just conscious spending.
Okay, so we have this map. But what happens when we look under the hood of that 20% bucket? Like, if I'm starting from zero, do I invest in the stock market immediately, or do I pay off my credit card first?
So the sources emphasize a very strict order of operations here. It goes safety, then debt, then growth.
Safety first.
Always. First, you build a liquid emergency fund holding 3 to 6 months of living expenses. And it has to be in a high-yield savings account, not stocks.
Because if the market tanks?
Exactly. If the economy tanks and you lose your job, you cannot risk having to sell your stocks at a 30% loss just to pay rent.
Right. That would be a disaster. Okay, so once that cash buffer is there, we pivot to debt. The sources talk about two attack plans, the avalanche method and the snowball method.
Yes. So Avalanche tackles the highest interest rate first. Snowball targets the smallest total balance first.
Wait, isn't the snowball method just mathematically irrational? Like you are literally volunteering to pay more interest over the long run.
I mean, mathematically, yes, it is entirely irrational, but behaviorally, it is highly effective.
Really? How so?
Well, humans run on dopamine and momentum, Paying off a $500 credit card balance in full gives you this immediate psychological victory.
Oh, I see. It proves you can actually do it.
Exactly. It creates the motivation you need to stick with a multi-year debt payoff plan. Avalanche saves you money on paper, but Snowball usually works better in reality because it hacks your brain's reward system.
That makes so much sense. So another mini summary for you listening. Protect yourself with accessible cash first, then crush your debt using the strategy that actually keeps you psychologically motivated.
Spot on.
All right, so bad debt is cleared, the safety net is built. Now we have to grow wealth, which means fighting inflation and, honestly, our own human nature.
Yeah, because saving just isn't enough. Inflation is this silent wealth killer.
Yeah.
Like, if inflation averages 3% a year, the cash sitting in your checking account is basically losing 3% of its purchasing power every single year.
It's literally evaporating.
Pretty much. So to outpace that, you have to acquire appreciating assets, stocks, real estate, things like that. And that brings in compound interest.
Which Einstein supposedly called the eighth wonder of the world.
Yeah, the classic quote. But mechanically, compounding is simply your money making money and then that new money making even more money.
Right.
But the catch is, it requires time and absolute consistency, which directly conflicts with our biological drive for instant gratification.
Oh, absolutely. I mean, one targeted ad for a new phone, and the money you meant to invest is just gone. So automating our savings is basically like putting up the bumper lanes in bowling, right?
Totally.
It prevents our inconsistent willpower from throwing a financial gutter ball.
That is exactly what it is. You reverse the friction. By setting up automatic transfers the exact day you get paid, The money moves into your investments before you even register it's there.
So you're forcing yourself to struggle to spend instead of struggling to save.
Right, you have to jump through hoops to self-sabotage.
Okay, final mini summary. Invest early to beat inflation and automate the entire process so you don't have to rely on daily willpower.
That is the art of money management right there.
It really is. Managing money is ultimately just managing life. It's the art of delaying instant gratification for long-term freedom. And to wrap up, we want to leave you with a final, slightly provocative thought.
Oh, this is a good one.
Yeah, if you wrote down your absolute deepest long-term life values right now, would your last 10 casual purchases actually align with them? Think about it.